It's time for Yahoo Finance's Market Minute. The tech-heavy Nasdaq leading stocks lower as the U.S. adds new curbs on chip exports to China. Nvidia shares down around 7% after warning it will take a $5.5 billion hit from those new chip export curbs. Nvidia will need a special license for exports of its H20 chips to China. Several analysts cutting their price targets on the stock on the back of that news. And AMD is also being hit by the new export restrictions. The company's AI chips also requiring a special license for the indefinite future. AMD saying it expects to incur costs up to $800 million. ASML shares down over 5% after issuing disappointing sales guidance. The company behind the most advanced machines used to manufacture chips saying tariffs have led to increased uncertainty in its market. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below where you can track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we're going to talk to one portfolio manager about 3 fundamental market drivers that can guide investors' approach to equity allocations in the coming months here. And mortgage activity. Yeah, that slowed last week as rates moved higher. We talk about the spring home buying season with a New York broker. Plus, all week on Wealth, we'll dive into the class of 2025's financial playbook. Whether you're a new grad or a parent of one, we'll break down the basics that you need to build a strong financial foundation. Today's focus, starting to pay back your student loans. You do not want to miss that conversation. We got all that and much more coming up during the hour. But first, let's take a look at some of the market action. We are 90 minutes into the trading day. We're lower across the board. Stocks falling today. Tech leading some of the declines. You're seeing the tech-heavy Nasdaq down right now by about 1.9%. We'll round that off too. Joining me now, we've got Alessio de Longis, who is the Invesco Head of Asset Allocation and Senior Portfolio Manager here in studio with us. You have 3 fundamental market drivers that are guiding your approach to equity allocations. Walk us through those.
Certainly. The biggest theme next to the equity sell-off that is making investors obviously concerned and arguing for a more defensive posture, the biggest theme that is emerging now is also the rotation from U.S. equities into international developed markets, especially from the perspective of the U.S. home-based investor. The U.S. exceptionalism story has dominated global equity markets for 15 years, and we're beginning to see some of the cyclical catalysts, but also longer-term structural catalysts for a more balanced rotation for that global equity exposure also into international equities. What are those 3 drivers that we like to watch? Relative earnings momentum. Relative earnings revisions are already arguing for momentum in the U.S. declining as a result of the big tech sell-off, and revisions in Europe improving as a result of the improved fiscal stimulus. Second, we need to see definitely a better tone in terms of global risk appetite. Global growth expectations are decelerating. This is not a good environment in and of itself to already rotate into international equities that are more exposed to global trade. And the third piece is the dollar. To me, this is the biggest potential long-term trend that is unfolding before our eyes. Both cyclical and structural developments are beginning to plant the seeds for a long-term dollar depreciation cycle, and with that, the benefits of diversification into international equities to benefit from that trend.
Okay, so what type of portfolio allocation should an investor be thinking of right now with all of those key drivers that you mentioned in mind?
Well, the first step is always the most important decision is equities relative to bonds. And compared to a standard, let's say 60-40 allocation that most investors like to be allocated to, this is a time where to be slightly overweight fixed income relative to equities. We think this de-rating of valuations still has some way to go. Now, importantly, within that equity portfolio, though, you can still maintain defensive exposures through low volatility sectors, defensive sectors, and as I mentioned, make sure that today, compared to the last few years, you're way more diversified into international equities, not just US equities. And on the fixed income side, careful with the potential widening in credit spreads and spread risk, so we would prefer to be invested in high quality investment grade fixed income.
You know, you mentioned the earnings season. What do you thinking that the common denominator, the theme of this earnings season might be?
The continuous adjustment to two themes. Obviously, the estimate, the guesstimate of the impact of trade tariffs across the board, across all sectors. So guidance, volatility in guidance is probably going to be a big theme. And the ongoing derating of the AI valuations or guidance around AI. Why? It seems like a long time ago, but what happened in late January with the DeepSeek announcement is a big, important development that in and of itself may challenge the assumption of nearly monopolistic conditions of US big tech with respect to AI R&D.
And so with that in mind, one thing that companies are also all talking about that kind of plays into the uncertainty that you were talking about a moment ago is just what the outlook for tariffs looks like and where their industries are or are not impacted. And of course, the kind of moving of the goal line on what seems like a good negotiation or deal making. I mean, all of that's kind of up in the air right now. So how does an investor kind of safeguard their own portfolio against some of those risks?
I think you're hitting the nail on the head. There is no rhyme or reason in the modus operandi that we are getting used to, right? So trying to use fundamental analysis, which we would have otherwise done, right, to try to gauge the likelihood of tariffs or the impact of tariffs doesn't necessarily pay out in this environment. So I would say acknowledging that the range of outcomes is much wider, so your confidence in the current outlook should be discounted. The one common theme, though, is dollar depreciation. In my mind, regardless of which tariffs and on which sectors and how these negotiations go, one of the outcomes that is consistent with the desire of the new administration to lower trade deficits is an environment of weaker dollar and stronger foreign currencies.
Alessio, great to see you here in person. Thanks so much for taking the time.
Thank you for having me.
Absolutely. Now time for some of today's trending tickers. We're watching Citizens and Travelers. Joining me now, we've got my Morning Brief co-host, Madison Mills. Maddie, we got to talk about Citizens Financial Group first. Citizens reporting adjusted earnings per share for the first quarter that beat analysts' expectations. We also know that revenue came in line with estimates. Net interest income, that came in at $1.4 billion. That's also in line with expectations here. So as we're continuing to track the stock here on the day, a few more things to break down with the companies, Citizens, as investors are evaluating.
Yeah, it's interesting this becoming the latest semi-read on the consumer in terms of how they're spending, but the company surpassing consensus EPS over the last 4 quarters here, not necessarily being enough to lift the stock. You can see that stock down a little over 1% at the moment, and you can see that movement taking up space this morning in terms of market movement here. I'm just taking a look at that EPS beat and also the net interest expansion here with revenue coming in at $1.94 billion. That was in line with expectations. And as I mentioned, that net interest margin number really key here, expanding by 3 basis points to 2.9%. The return on tangible common equity reaching 9.6% as well. The CEO talking on the earnings call saying we delivered Q1 results that were in line with our expectations, talking about the company's strategic focus on balance sheet optimization and operational resilience in an uncertain economic environment, just becoming the latest CEO to talk about that uncertain economic backdrop amid the trade war that is continuing here, but not necessarily saying there's any sign of a recession to come, just continuing to repeat the uncertainty line.
Yeah, and that's something that we've heard at the start of this earnings season repeatedly, and we were just talking about with our previous guests as well. Next up, we got to talk about Travelers. Travelers rising after a big beat on first quarter core earnings per share. Analysts noted that most of the beat was driven by business insurance results. We're continuing to track shares of Travelers right now. They're getting a little bit of a bid today. They're up by about 4.2% right now.
Yeah, also raising the cash dividend to $1.10 per share from the previous dividend of $1.05 per share. You can see the stock price up a little over 4% at the moment. Most of the Q1 beat driven by business insurance, according to an analyst over at Morgan Stanley, talking about how there was a little bit of a mixed picture under the hood here. Underwriting was strong on personal audio premiums. Growth was a bit soft, saying that the key will be how management navigates the uncertainty moving forward. Piper Sandler iterating a similar theme, saying the first impression is that it was a good quarter for travelers, but obviously calling it a first impression. So when you look under the hood, there is a little bit more uncertainty. Having said that, Evercore actually having a little bit more of a positive tone, saying that Travelers once again is setting a high bar for peers with underlying and underwriting and solid pricing, but the better underlying results in auto and home are likely unsustainable given tariffs. So that tariff uncertainty really being the theme for this earnings season already.
Tariff uncertainty, one part of it, but it also depends upon how you project the natural kind of unconsiderable, you can't predict what catastrophe losses are going to look like, is what I'm trying to say at the end of the day.
Yes.
And the number of billion-dollar disasters has continued to rise year over year. And so with that in mind, catastrophe losses, they did note, and you think about what happened early onset in 2025, the California wildfires, they did actually mark within this catastrophe losses of $2.266 billion pre-tax, primarily driven by that event. So it really does hinge on, especially for companies like Travelers, what those catastrophe unfortunately look like going forward as well here.
Yeah, and that severe wind and hailstorms also being a headwind there as well.
Maddie, thanks so much.
Thank
Appreciate
you,
it. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Yahoo Finance Executive Editor Brian Sozzi sat down with U.S. Treasury Secretary Scott Bessent, pictured here, to discuss a wide range of topics, including tariffs, taxes, the bond market, egg prices, and even personal finance. Sozzi asked Secretary Bessent about how Americans can go about becoming better investors with some of the uncertainty clouding the markets and the economy. Here's what Bessent had to say.
But I think the most important thing that households can do in terms of financial literacy is understand your goals and understand the products that you're invested in and kind of do a gut check and rate your personal risk tolerance. And obviously, a young person should have higher risk tolerance and a longer horizon. If you're getting closer to retirement, then your risk tolerance should be lower. But again, too, that there are no get-rich-quick schemes.
Coming up, the New York International Auto Show. We take you there live, where our senior autos reporter, Prosper Bermanian, speaks to Hyundai's Chief Operating Officer. Stay tuned. President Trump weighing a possible delay to auto tariffs. But as of now, there is a 25% tariff on all imported cars, with a 25% tariff expected to take effect no later than May 3rd on car parts. Let's go now live to the New York International Auto Show, where senior autos reporter Prosper Bermanian standing by with Hyundai Motor America COO Claudia Marquez. Pros, take it away.
Yeah, Brett, thanks for that. Yeah, that's the word of the day, right? Tariffs at the auto show everywhere we go, but also new cars here at the New York Auto Show. Claudia, thank you for joining us. Really appreciate it. So before we get into the new Palisade, which is right behind us, Brad talking about tariffs, sort of what everyone's talking about these days with President Trump's sort of focus on the auto industry. What's sort of Hyundai's position on that right now from where you're seated?
Of course, our position will always be we have to take care about our customers. It's a tough situation, yes, because there is a lot of uncertainty. But first of all, I want to share, and I'm sure that you know, but obviously for the audience, Hyundai has been in the U.S. for the past 40 years. We have a strong representation in the U.S. We have a factory in Alabama, and just recently, 2 weeks ago, we opened our new Meta plant in Savannah, Georgia, where we produce our EVs, Ioniq 5 and Ioniq 9. Just to give you perspective on that, 2024, we sold 836,000 units, and about 40% of the vehicles were produced in the U.S. So we are very confident on the market. Of course, the U.S. is very important for us. We're fully committed to localization. We understand, of course, the need for investment in the U.S., and we are playing a part of that. Now, when it comes to the customers, which again is tough, and even for us, just for planning purposes, what we wanted to make sure is that we have a plan for our customers. So we launched our Hyundai Assurance program, which is confirming and assuring to the customers that MSRPs are not going to go up, in this at least this couple of months. So we are very good in uncertainty. We call it the Hyundai speed. Then we're doing and we're very prepared to deal with this reality, and again, always committed to the U.S.
Right, so it's a day-by-day, month-by-month plan.
Sometimes hour by hour.
Hour by hour,
Yes.
and you're planning to right now, protect your consumers. So I think looking more long-term, part of the Hyundai toolkit, I believe, is investing in America with the Meta plant, building here. Is that sort of the toolkit you guys have? Is that sort of what you guys have been leaning into, even though that's years, it's billions of dollars of investment?
Hey, we're talking about tariffs, and all of this started in the beginning of 2025. I just want to share as well that it's not only that we have been with a factory here, but in 2019, the company confirmed an investment over $12 billion, which is a part of the Savannah plant that we just inaugurated a couple of weeks ago. Really building a factory takes at best 3 years. Hyundai did that in a little bit shorter term. But that's all in all to say that, it's not about tariffs, why Hyundai Motor Group is investing in the U.S. The U.S. is a very important market, it's the most important market, and we are here to stay for the long run and to invest in the U.S.
So speaking of that U.S. market, the SUVs kind of run the roost here, and the Palisade behind us is the newest one from Hyundai. Talk to us about what changes were made to this new vehicle in response to the U.S. market.
Today we just left the press conference revealing the new Palisades, which I'm extremely happy and proud about. So the 2026 Palisades is our second generation. One of the things I am happier on many others is that for the first time we are going to have a hybrid also as powertrain. The current generation was only available on ICE. Aside of that, of course, you can see a very bold, attractive, great design. We also are introducing with a different design Palisades XRT Pro, which also was presented in here. Safety, which is extremely important for the company, always under the promise of our brand promise, is amazing.
Right.
So design, safety, technology,
hybrid,
powertrain, exactly.
So I know hybrids are we get that a lot of interest there at Yahoo Finance. People talk about that, but also EVs, the Ioniqs at Hyundai have been doing quite well here, right? In particular, the Ioniq 5 has been a hot seller. What's the game plan there for EVs? We have the hybrid game plan here with the Palisade.
Yeah.
What's next for EVs, and how do you accentuate what you already have with the product?
Hyundai will and continues really in a long term the EV strategy. Again, Ioniq 5, Ioniq 9 being produced in the US. What is going on today, of course, is in a little bit slower adoption for some of the customers. What we're doing, of course, is offering hybrid, as we were talking, which is like the short term until customers are actually convinced. But just to give you statistics on this March, for example, which was our last month, the last month we closed, we had our best ever March and the second best ever month since the launch of Hyundai in the US. And out of that, 72% of the volume in March were hybrids, and year on year, and 38% were EVs. So we're here to stay with EVs, and extremely happy about performance, design, availability. Ioniq 9 is going to be launched soon enough. Coming back to Palisades, we're going to launch in summer the ICE version, in fall the hybrid version. So many positive news in front of us.
So building in the U.S., electrified powertrains, new products, and price protecting customers for now.
That's
Claudia
right.
Marquez, COO, Hyundai USA. Thank you so much. Really appreciate it.
Thank you so much for inviting me.
Of course, thank you so much. And back over to you, Brad.
Thanks so much, Pras. Appreciate that. We'll have more from Pras at the New York Auto Show. Mortgage applications fell 8.5% week over week as mortgage rates moved 20 basis points higher, according to the Mortgage Bankers Association. The new data also showing refinance volume dropping 12% and purchase volume falling 5% for the week. So how does the new data factor into the spring home buying season? Joining me now on set, we've got Noble Black, who is the associate broker at Douglas Elliman. Great to have you here in studio.
Thanks for having me. Yeah.
All right, so just take us into some of the stories that you're hearing from potential buyers and sellers in this market behind some of the integers, the data that we're also seeing come forward.
Sure. I mean, I think it's important to look at the data, which was last week and the week before. That's one blip, right? So we have to look at the overall trend that we're seeing. What we were seeing going back into the fall through the end of the year, and especially first quarter, was an incredibly robust market nationwide, especially for New York and the luxury markets, which I cover. I can't underestimate or understate how strong things were going into 2 weeks ago. I think it's not surprising that as the yields on the 10-year went up, mortgage rates went up, a lot of those buyers that were more price sensitive, that needed to finance, just took a breath. It's not that we had a mass exodus out of the market, but I think they were like looking and kind of getting their footing.
Yeah, within this release that we have from the Mortgage Bankers Association, their chief economist and senior vice president saying one notable change last week was the full percentage point increase in the ARM share, and given the jump in rates, more borrowers opting for lower initial rates as well here. So with this in mind, what does the setup look like as we are here in the spring home buying season? It's supposed to be the most wonderful time of the year, essentially, for the home sector.
Look, I'm still optimistic. It would be crazy to say that everyone's not proceeding with a giant question mark above us, right? But again, we were coming into a very healthy spring market, I will say, for New York, for the luxury markets. LA's been doing very well, Palm Beach has been doing very well, Aspen. There was incredible demand behind those. I think once this happened, everyone's kind of taken a breath. The people that are truly rate sensitive, that need to finance, I mean, if you look at our first quarter until this happened versus last quarter, the mortgage deals grew at twice the rate of the cash deals, right? So you really had, as rates had ticked down a little bit, a lot of those finance buyers coming back into the market. There's still an affordability issue for a lot of people, right? So this has given them a reason to take a breath and see where things are going to go. For some people, it put it that much out of reach. For other people, it's just, you know what, I need to make sure that things are not going totally haywire before I proceed.
At this level, does the affordability issue, which some have called a crisis within the housing market, does that affordability issue persist at this level if we stay even within this same ballpark? Or is there a sweet spot that you see mortgage rates moving towards that could alleviate some pressure and introduce some new buyers potentially into the landscape?
I think the affordability issue is going to be with us for a while, and that's only going to be fixed by a lot less regulation, right? And there's different proposals on both sides of Congress, but there needs to be some action, whichever side they go with, whatever they're doing. If they're doing incentives, if they're doing tax decreases, whatever it is, that's the only way to truly fix it. Now, certainly as mortgage rates come down, it's going to give a lot of help to a lot of people. You know, I think if you talk to anyone, if we're getting to mortgage rates that are probably 100 basis points below where we are, you're going to see a drastically different market. You know, it seems like are baking in probably another 50 basis points, rate cut. Wherever that goes, it's going to be in the right direction, but certainly the more the better. I don't think there is a sweet spot by which the switch turns.
What does that mean then for the rental side? Because this is kind of two-pronged. It hits not just what's taking place on the housing side and home purchases, we should say, but also those who are renting more long-term.
If you are looking to rent, it's an ugly scenario right now. It is a very, very, very tough rental market, and that's been the case for a while. Again, we have less supply than we need. The rental rates have gone up in Manhattan. They're at an all-time high. That's only getting worse as you've got mortgage rates going up, as you've got uncertainty in the market in general. It's keeping people in the rental market, and it's pushing some people in the rental market. And that's bad news if you're looking to rent.
So let's end with some good news then, perhaps. What are the top reminders that people need to keep in mind if they're going towards any of those open houses or looking at some new home build outs potentially, and they're trying to make sure that they can advocate best for themselves?
Yeah, I think look at the market that you're in, because all of these markets are not the same, right? There's more flexibility in pricing in the Sun Belt. Even Miami has more softness than what Palm Beach was. Like, prices have softened there, whereas in Palm Beach they've gone up a lot. So you really need to know your micro market, right? Manhattan is still moving very, very well. It's slightly less than it was 2 weeks ago, but it's at an all-time high. We had the best first quarter. So know what you're looking at, right? Have your finances in order. If you're going to go in, if you're getting a mortgage, you need to be pre-approved. You need to have all your documentation ready, and have somebody that's going to advocate for you. Go in and either talk sense to you and be realistic with the offers that you're making, or educate you on where you should be going.
That's a great reminder. Noble, thanks for taking the time
and
to be with us. Yeah. Coming up, we get a read on the health of the consumer with the CEO of Stu Leonard's. That's next on Wealth. 2 hours into the trading session, let's get you a check of the markets right now. The S&P 500 still fractionally lower. The Dow Jones Industrial Average had just barely snuck into positive territory here. Let me try and tap that again. There we go. However, it's just barely moved off of its intraday session high. We'll see if we can retain this kind of flat line, get back into positive territory as of right now. I'll show you a look at the components in just a hot second so you can see what's outperforming at this juncture and pushing it into that higher territory, at least on the day's activity. There you're taking a look at the S&P 500. Here's a look at the NASDAQ. That's down by about 1.5%, but again, off of the session lows here, and taking a look at the heat maps where we can kind of fire up and get a sense of what's outperforming, what's lagging here on the day. As of right now, technology, and this kind of mirrors what we saw within the major average activity that we just laid out at the start of this check-in. The technology sector, XLK, that's down and leading the losses right now by about 1.9%, pulling up the caboose. But we do have the majority of the sectors of the 11 S&P 500 sectors in positive territory, led by energy right now. That's up 2.25%. Real estate also catching a bid here on the day. That's up by about 1.2%. Here is the largely red picture that we're seeing on the NASDAQ 100 on the day. We're pulling up the caboose. You have some of those semiconductors names: ASML, AMD, NVIDIA. Of course, $5.5 billion is what they're noting is going to be the net impact of some of those H20 chips. They disclosed that in an SEC filing last night. And then additionally here, taking a brief look at the Dow 30 components so you can get a sense of what's actually pushing us to the upside there. And to no surprise, at least it shouldn't be to any surprise, it is energy. This is kind of mirroring what we were seeing on the sector basis. And then also travelers. They just reported earnings here, and you're seeing that stock move higher by about 4% right now. Well, retail sales came in stronger than expected in March as consumers seem to be rushing to get ahead of President Trump's tariffs. While spending is up, consumer sentiment has fallen significantly as Americans express concern for rising prices and economic uncertainty amid trading policies and changing trade policies. Joining me now on the state of consumer, we've got Stu Leonard Jr. He's the CEO and president of Stu Leonard's Grocery Stores. Stu, good to see you once again. What are you hearing from your customers who make their way into your stores, through your aisles, and hopefully to the cash register? I don't know if they're smiling, frowning. What's going on?
Hey, first of all, Brad, you got a lot of energy there. I'm just watching you bounce around that screen right now. I'm going to be a little more.
We're keeping it lively here, Stu. Keeping it lively.
Hey, but anyway, we have a family business here in New York, New Jersey, and Connecticut with 8 stores. You know, and we have hundreds of thousands of customers a week come through Stu Leonard's. And so we got a pretty good feeling of the pulse right now. And I would just say we're getting ready for Easter and the store's busy. You know, our customer count feels up. The mood of the customers feels pretty good. I don't hear about this panic buying like I did during COVID. Our toilet paper is still full shelves there. So, but we're mainly perishable here at Stu's. So some of the items that could be affected by the tariffs today are part of the NAFTA agreement. So there's been zero increases in any of our suppliers, importers with pricing.
That's good to hear. And I wonder, as you're kind of breaking out what you're kind of feeling in the customers and what you're hearing from customers versus and stacking that up against what you're seeing in the data that's coming through on a per ticket basis, what is that average ticket looking like if you're kind of thinking about some of the comparisons that you would normally run?
Hey, you know what, right now, Brad, sales feel brisk right now. We're coming into Easter. Our catering orders are up. Our catering orders are up. And you know, we feel good about the sentiment of customers. You know what everybody's really happy about? These guys right here. Eggs, okay? The egg prices are almost going down in half, so people are happy. I'll tell you what I'm worried about. How about this guy right here? Look at this. Okay, how about this guy? That's one of our salmon, right? So this is what we get from Canada every year. We get them every week. We do 500,000 pounds of salmon. So that price, I just talked to our fish buyer this morning, no increase in price. The thing that makes me a little worried, like right now, is bananas we get from Costa Rica and down south. Those and same with these pineapples. These are all southern So those have been bumped 10% on the tariffs, but our suppliers are holding. So sort of the mood right now, it's a lull before the storm. None of our suppliers have been raising their prices. A lot of them are just saying, let's hold on and see what's going to happen here over the next 2-3 weeks. Because in our business, we got to do volume. We got to do a lot of volume. When you raise prices, sales go down. So we are not raising prices right now. We're trying to hold and we're taking it day by day.
Stu, first and foremost, you always know that I love having you on the show because I never know what you're about to pick up. I did not have you picking up a whole salmon on my bingo card here, so thank you for surprising to the upside as always here. You also picked up a carton of eggs, and wholesale egg prices have dropped significantly in recent weeks according to the USDA. Are you seeing this fall in wholesale trickle down to consumer prices?
Well, you know what? A lot of this has to do with energy. We're still spending a lot of money. Our kilowatt hours, even in our company, have almost doubled this year now. And so energy is a big thing. Transportation costs to get, bananas and pineapples. And, like another thing that worries me, all the lamb that's coming in from New Zealand right now. We have our own little, quote, tariff negotiation going on with our supplier. But here's the thing. It's Mary Beth. They have a beautiful little family farm in New Zealand. They raise the best, animals and sheep. Of course, New Zealand, there's more sheep than humans. But, and they're a beautiful little family business. I'm going to try this afternoon to work it out. She's going to want the 10%. I'm going to try to say, hey, Mary Beth, if you could hang on and do 50-50, I'll eat half of the tariff plus 5%, you eat half the tariff plus. I did that during COVID. She kept our shelves full. It's my turn to help this small family business out. I don't want them to be harmed too much because of the tariffs.
And Stu, in real time here, live on air, you're actually giving us a lot of the dialogue that many businesses are trying to work through right now with their partners. What is the pulse that you're hearing from other retail CEOs that you may be in conversations with them and the rest of us are just the consumers on the other side trying to figure out what our cart may look like?
Well, Brad, here's the thing. We got to work differently. Like, I'll give you a good example. Here's tequila right here, okay? Now, this is only made in Mexico. If this goes up in price, okay, and it's not right, or it is, that's going to be tariffed right now. Where are you going to buy tequila? After that, there's nobody else in the world produces it. So that makes you a little bit nervous with products like that. Although what our tequila importer, they brought plenty over stateside already. So they said, don't worry about anything for like the next month or two. We got plenty of product. The other thing, like you have things like, here's a beautiful French champagne, that comes in. But here's one, the same family out in California, Domaine Carneros, will make, it's the same family, but it's not called a champagne, it's called a sparkling wine. It's about half the price. Our customer's going to switch from a European wine or spirit. And are they going to start buying U.S. products instead?
Yeah.
Because of the tariffs. So that's what we're waiting to see. I wonder what's going to happen on that one.
Yeah. Well, Stu, I've been having the champagne of waters on my side, which is essentially just sparkling and bubbling water. That's what we can do right now. Stu.
How about this? Come on over, Brad. We'll have some champagne and brie cheese together. How's that?
Look, I'm on the next train up there. Stu, thanks so much for the time, as always.
All right. Hey, happy Passover, happy Easter to everybody. Thank you for having me on today.
Same to you.
Okay.
Coming up, we have your 2025 grad playbook today. We'll tell you everything that you need to know about student loan payments. That's after the break. Student loan debt in the United States reached a staggering $1.77 trillion in 2024. As part of our theme week, the class of 2025's financial playbook, we're covering the basics of paying off those loans, whether you're a new grad, recent grad, or parent of one. Joining me now, we've got Amanda Haenel, who is the Fidelity Investments VP of Emerging Products Student Debt. Amanda, great to have you here with us. So let's just start simple here. How do you find out how much you owe?
It's a great question, and it can be a little confusing. So the first step is to actually go through and understand who your loan servicers might be. If you don't know, you can go to the Federal Student Aid website and look for all of those loan servicers. Then you can log on to their sites and they'll tell you what actually you owe, what the amount, the due date, and your interest rate is for all of your loans.
So when do graduates need to start paying loans by?
Yeah, so it depends on what kind of loan you have and if you're in a period of forbearance. You have a little bit of time after you first graduate to catch up and get, a little bit settled in your new career. But after a couple of months, those loans will start being due. For a lot of people who are not new grads, but are starting to repay them after a period of time of uncertainty and when student loans were paused, they may not realize that they actually owe student loans today as well. And so your student loan provider will have all of that information with all of the information for your particular loan and your individual situation.
Okay, and so speaking of and thinking through what your situation may look like, let's say you miss a payment or, a few. What are the consequences there?
There's a few consequences. So the most immediate one is if you start going from delinquency into default, you'll see your credit scores impacted, and that can make it harder to take out debt, to get any kind of loans, even employment history. Once you're in default, you can also start having wages garnished. So you can be in a situation where all of a sudden you have a little bit less coming in from any kind of federal payments or even from your job.
So though there are minimal monthly payments, it's always an option to pay off more. What are the benefits to paying off student debt early?
First one is it just feels better to not have that weight and that burden as you're coming through. A lot of people are very stressed about their student loans, and so that mental impact can't be understated. In addition to that, you're going to save money on interest payments. So if you pay back faster, you won't have as much accrued interest, and then you'll be able to free up your finances to be able to do other things, to be able to, buy that house or get married or have a kid, things that a lot of folks delay as they're trying to manage their student loan debt.
And so for households that are trying to figure out how their students can best position themselves, especially knowing that there's kind of a range of different expenses that are also going to start coming your way. And these are early earnings years as well. You're trying to get a job, you're trying to get set up, and you don't know if you'll have to move for that job or what other expenses you'll take on. Where do these student loans kind of prioritize or get prioritized in that range of expenses that could start to come forward fast and furious?
It's a great question for a lot of different people. It's going to be after emergency savings that they're coming through, but you should look at your own individual situation. You can go to fidelity.com/student debt help to get additional personalized guidance about what your priorities are, see your student loans in context of your broader financial picture, and to think about how you can manage your expenses that are day-to-day, your long-term savings, and your student debt liabilities as you're coming in to make sure that you have the best financial solutions for your situation.
Amanda, thanks so much for taking the time here with us today. Appreciate it.
Thank you so much.
Coming up, President Trump is touting NVIDIA producing more chips in the U.S., but can the tech industry really be onshored? We're breaking it down on Wealth. It's time for Tech Support, our weekly segment all about technology and shares of one of the biggest tech companies out there, NVIDIA, taking a hit today after news the company is expecting President Trump's curbs on Chinese exports will cost the company $5.5 billion. Meanwhile, President Trump touted NVIDIA's investment in the U.S. on Truth Social, calling it big and exciting news. I want to bring in Yahoo Finance tech editor Dan Halley. Dan, good to see you. Will Trump's tariffs really bring tech manufacturing to the U.S.?
Long story short, no. This is something that is kind of akin to what Apple did with their $500 billion announcement saying we're investing $500 billion over 4 years. But it's not necessarily all, like iPhone production lines or anything like that. It's about building servers in certain factories and spending on other things. With NVIDIA, it's about producing some of their Blackwell chips at TSMC plants in Arizona. But this isn't, a wholesale movement of NVIDIA's supply chain or any company's supply chain to the U.S. And that's just not going to happen anytime soon. In fact, a number of analysts that I spoke with basically said, look, this is a way for these companies to kind of play the game and ensure that they're on Trump's good side while also making kind of strategic investments. Obviously, TSMC has been building plants. They have $165 billion earmarked for plants in Arizona. Companies like AMD, NVIDIA, as I mentioned, Apple, they're using those plants to build these chips. But it's not the volume that is going to, the type of volume that's going to fulfill all of the needs of the U.S., let alone the world. And I think this is, as I said, more about strategic relationships with Trump than anything else.
So is it really possible to deglobalize the tech industry? And what type of risks are we talking about here?
Yeah, I mean, look, it's not, right? I mean, look at things like just silicon, right? The actual wafers themselves come from different parts of the world. I mean, you just break down a semiconductor, and all of these pieces, it's a global industry. It's impossible to move these things just into the U.S. That's wild. And so that's just the chips, right? And then you look at everything else that use the chips, right? Smartphones. If you want to try to build iPhones in America, you can maybe do the final assembly here, but you still have different pieces coming from different parts of the world. And it's not just Southeast Asia and China, though that's where a huge majority of the pieces come from. It's also areas of Europe and South America, things along those lines. So this is something that appears to be more of a fool's errand than anything else. It's more about, look, the Biden administration had this idea of ensuring that there was more semiconductor capacity in the U.S., which makes sense. But semiconductor capacity means building the chips. There's more steps to just building the chips. There's, as I said, the silicon, there's the packaging. Those need other plants. It's not just like, you push in a bunch of like a silicon wafer and out comes a chip that you then drop into a computer. It's much more complicated than that. And so it is truly a global supply chain. There's really no way to fully onshore all of tech manufacturing, let alone a piece of tech manufacturing like that.
And you make a great point in that it's always back to it's everything from the natural resources in the type of silicon you're being able to get and the raw materials, all the way through the packaging, the product, the lithography that takes place as well. So much to consider here. Dan, thanks so much for breaking this down for us.
For sure.
Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up 3 p.m. Eastern Time. You don't want to miss it.